it had been building this beautiful chart pattern, that beautiful, massive, gigantic wedge I called the best chart pattern in the world, and a break of 10,000 was going to be the confirmation. And I loaded up with every single penny that I had available. And so I put it all in to Bitcoin, and it broke out. I had always said that crypto, and Bitcoin in particular, and macro were the same thing. They just didn't know it yet. And most participants didn't know it and didn't understand it. Crypto came from a different community. It came from a community of developers, the kind of cypherpunks. It came from Austrian economic school kind of philosophy. It came from libertarian philosophy. It came from a number of different things, but it started to attract the attention of finance people, particularly the macro guys like myself. You know, our job is to find assets that best represent our views and where we are in the world. And we are all, without question, troubled by the debt supercycle and how this all plays out. So when we saw Bitcoin, you know, one by one, people moved across. Famously, Dan Morehead was first. And then a lot of people, whether it was John Burbank, Mark Yusko, whether it was Dan Tapiero, whether it was myself, Mike Novogratz, I mean, bit by bit, everybody from the macro world, Stan Druckenmiller, Paul Tudor Jones, Alan Howard, you name it, they're all moving across because they've seen the magnitude of the opportunity, because we all knew that they weren't parallel paths, they were convergent paths. And they all converged last March. So that's when I got really excited, when Bitcoin collapsed in the big liquidation. It had been building this beautiful chart pattern, that beautiful, massive, gigantic wedge I called the best chart pattern in the world, and a break of 10,000 was going to be the confirmation. And I loaded up with every single penny that I had available. And so I put it all in to Bitcoin, and it broke out. Because what was going on was we were now going into the biggest recession, maybe in all recorded history. So as you remember, my thesis was liquidation phase, which was into March. Then I closed out all my shorts. Then it was going to be the hope phase. And then it was going to be the kind of insolvency phase. So the hope phase happened. And that was built on vaccines and things are going to be okay and herd immunity and all the narratives that happened. But something different happened as well. Interesting enough, the real-time economies never really picked up for a while. They did exactly kind of as expected, but the markets did. The markets did the opposite. You know, I said we'd probably finish the year at kind of -3 to -5% year-on-year GDP growth, and that's exactly where we got to. So the hope was misplaced because the economy was shit, and people had been laid off, and the structural unemployment, and many of the people in retail, for example, are never going back to jobs again. So there was a real structural problem. The insolvency phase should have been that the triple B entities, the giant corporates, should have run out of cash because they didn't have enough cash flow to paper over the debt payments that they need to make. So it becomes harder and harder, their equity price falls and it all becomes more difficult. But that was also going to happen at household level, where households were, yes, some people were furloughed, some people were given payments, but eventually the payments stopped. And if they didn't have jobs, the musical chairs stopped and you're kind of screwed. And the same with small businesses. So we saw immediately the government do something it's never done before, which was instant transfer payments, which was stunning move towards a more MMT style environment where fiscal policy and monetary policy are roughly the same thing, or they work hand in hand, which is what we've seen in Japan over the years. That was amazing. It helped a lot of people and basically delayed the insolvency phase. Technically, many firms, many people, many businesses are insolvent, but they're kind of being kept alive by the central banks and the governments. And still to this day, we're still in that same cycle. It's become apparent, and I talked about it in the past, is governments and central banks have to do absolutely everything to avoid the insolvency phase. My guess was they were unlikely to resolve it all, and I think it actually plays out longer, and it is actually in reality in play but we're not going to know until we try and revert back to some sort of normality. This is one of the key reasons why the central banks simply cannot allow rates to go up, because you will destroy any chance of recovery. So anything, if the market wants to go there and try and price in higher rates, yield curve control is going to kick in. We've got pseudo yield curve control in Europe, and we've got yield curve control in Australia, we've got it in Japan, and I think it would come in the US. And that means that rates can't actually price inflation. Now, I'm not an inflationist. I think we will get cyclical inflation because of the supply constraints and the massive rise of people coming back into the labor force and back in economic life. But as we settle down, I think the debt deflation narrative, technology, globalization, aging population, all of this stuff continues to weigh on inflation. And over time, as the economy settles to trend rate of growth, potentially inflation falls. I actually think trend rate of growth might change positively, and I'll come on to that at the very end of this, but it's not really a piece for this, and that all comes later. But it's the macro backdrop of that is very important to understand, because within this, the only answer was the creation of more money. And that creation of more money was clearly going to be very, very beneficial to Bitcoin, because it was basically created for this. And I pointed out early on, back in March and April, that Bitcoin was two things. It was this store of value narrative. And it also had a call option on the future. And I started developing some big meta-narratives to help get people across the line, because I know it's a scary, different world and people don't want to understand this weird digital money. I don't want to throw money at this. But I tried to explain to people in simple terms things like pristine collateral, how this is superior than many things that we have in the existing system, or in fact, all of the things that we have, how it acts differently, how you can't create more of it, so it's collateral, it's worth more, and therefore is a better foundation stone for the financial system of the future, and how as a store of value, it offsets the monetary printing, and how this could all transition into a future economic system that had incredible value. And that's what made me irresponsibly long. And that, I think, helped a lot of people get across the line. The next part of it that I think was maybe the light bulb moment for many was my New Bretton Woods, the Bitcoin Life Raft piece. And that essentially was saying that, okay, what also is coming is the central banks have seen this digitalization of money and they want to be involved. And they want to be involved by creating central bank digital currency, not as a competitor to Bitcoin, but as an ancillary agent within this new digital money system. And that's all well and good. That's basically government stablecoins. Fine, I get it. It's much better. It works really well. But it also has other qualities, because the other qualities are it's programmable. So essentially, central banks can program money so we all have different monetary policy or different tax regimes or whatever it may be. The point being is behavioral economics is going to shoehorn its way in to monetary and fiscal policy, which are combining. And at that point, we are really beholden to what central banks do. Can they destroy money? Can they destroy our capital, our savings? Of course they can. And we needed a life raft. And Bitcoin was going to be it.